Eurozone business activity surprisingly strong with one standout performer. We'll get into all of it on today's episode of Market Insight. I'm your host, Leah Mishkin. So, despite manufacturing remaining weak all across Europe's largest economies in August, the S&P PMI composite number came in at 51.2, stronger than expected. France's services sector got a boost from the Olympics and was that standout performer, but Europe's largest economy, Germany, struggled and remains in contraction. Meanwhile, in the UK, the composite number of 53.3 exceeded expectations thanks to better performances by both the services and manufacturing sectors. Let's bring in our guest, Ed Leggett, equity fund manager at Artemis. Ed, thanks for being on the show. What do you make of the latest data?
I think it's showing a similar trend that we've seen before in the previous 3 or 4 months, and we've seen for a while now, particularly on the manufacturing side in Europe, where the industrial base in Europe, particularly I guess in that metal-stud heartland in Germany, has really suffered post the energy crisis as a result of Russia and Ukraine. And then on top of that, I think the weakness you're seeing in China, those exports that were a big driver of that part of the European economy, so things like autos, things like machine tools, going into China in particular, that has slowed, dramatically and even reversed, I think, in the last few years. So that's weighed on the manufacturing side, and those sectors are so big that I personally think if you know where auto production is going, you have a pretty good idea where the manufacturing PMIs are going through time. If you look in a UK context, it's obviously an economy that's far more geared to services. Manufacturing is a relatively small part of the economy, but we've seen, directionally, I think similar trends, albeit, on the manufacturing side, we've just seemed to have been slightly ahead of that cycle, I think, because, the energy costs, again, hit us quite hard in the UK, but have subsequently, unwound quite rapidly.
And we're expecting UK consumer confidence data tomorrow. You've mentioned it's already been rising sharply. What do you expect to see?
I expect you'll see, hopefully a further improvement. I mean, it's still negative. The UK consumer confidence, if you look at the numbers, has been negative for most of the last 20 years. But it's come from a very, very low base at the time of the Trust's mini budget. Was pretty much the lowest number we'd seen since the war back then. And you're seeing it now, has progressively risen strongly. And I think what we've been surprised at this year is actually that the savings rate for the UK consumer continues to rise. So the UK consumer, hasn't really been driving the economic surprises that we've seen in the UK so far. But we think with the interest rate cut, with the election out the way, there will now be, I think, a pickup in consumer confidence as we go through the second half of the year. And what the new government needs to see is for consumers to have the confidence to come and spend, as that's going to generate, tax revenues, generate economic growth, generate jobs, and get back more into a sort of virtuous circle of growth and tax and a rising tax take.
So what does that mean for investors, and what do you suggest people buy stocks in if people are spending more money?
I think when you think about the economy being stronger in the UK, then we certainly think a lot about the currency. Sterling's back at 131 today versus the dollar, and I think as you look forwards, you've got potentially a scenario where inflation is above target in the UK. The Bank of England is having to upgrade their growth forecast in the UK, and against that backdrop, we find it quite hard to see how they cut rates aggressively. And if other central banks in the world are cutting rates, then suddenly the UK becomes, a liquid currency with a carry trade, and may well, we think, continue to strengthen. That will benefit domestic companies, particularly ones that import, and a sector where we've seen, a big currency headwind for the last decade, as an example, would be retail. And so, that would be something you'd expect to benefit both from the consumer confidence rising, but also from being able to pocket a bit of gross margin as they can just purchase the same goods for cheaper because sterling's strengthened.
And so what sectors would you still remain cautious on the flip side?
In a UK context, I think looking at luxury as a whole, there's been a clear trend in the last 12, 18 months of consumers sort of starting to trade down again, and you've seen that in spirits, you've seen that in luxury goods, You know, there isn't so much signs of seeing that in experiences, so things like travel yet. But that's certainly something, I guess, at the margin that we still be a bit cautious on. And those companies, have a lot of sales in emerging markets, and the emerging market consumers' preferences, I think, are changing through time more towards local brands and away from some of the developed world brands.
All right, and I can't let you go without asking what you're hoping to hear out of Jackson Hole from the world's top central bankers.
I guess I think everyone's crying out for clarity on where the short-term move in the interest rate cycle is. For us, I think it's we spend much more time thinking about ultimately where is long-term core inflation going, and that's the big question. So any clarity they can give around thinking around that, I think, would be helpful, as that is going to drive where long-term rates are, which in turn will determine where risk assets are priced. So it's not so much will we get a rate cut in September? It's more actually thinking around what are the inflationary forces in the economy, and are we in a different environment than we have been before for all the sort of reasons that people have talked about: decarbonisation, deglobalisation, an aging workforce. All those things, I think, are of far more interest and will be the bigger determinant of investors' long-term returns.
All right, Ed Leggett, Equity Fund Manager, Artemis, many thanks for your thoughts. That is Market Insight.